Hi, I'm Tami Fratis, Managing Director of ACT Capital Advisors, and I'm here as the host of Money Matters TV. We have an exciting show today. My co-host is going to be Doug Bloom of DAB Ventures. Hi, Doug. Welcome to the
Hi,
show.
hi, Tami. How you doing today?
Doing great. How about yourself?
Good day.
Well, welcome to the show, and I'd like to, if you don't mind, have you tell us a little bit about your business and what DAB Ventures does for its clients.
I'm a DAB Ventures is a growth advisory for small to medium sized businesses. We help uh, CEOs and their senior teams get clarity around what they're trying to achieve, set some realistic objectives and goals, identify ownership of responsibilities, key core metrics, some cadence around reporting and discussion, and we have some fun as well. I'm a Pinnacle Business Guide, which is a business operating system based on flexibility and effectiveness.
And what are some of the most common mistakes you see from businesses that are growing very quickly?
Well, there's kind of four simple stages of business growth. One is instantiating the business, which is the startup phase. Then there's the second phase where companies grow into, and it's a repeatability of customer, repeatability of process. Then they get into a sustainability march, and then finally they go for scale. When businesses grow out of instantiation of the business, they're doing everything they can, like a one-arm paper hangers. And if they try to scale that chaos, they end up with a lot of problems. You can't scale chaos. That's that transition from being let's get it done to let's do it well is the core transition. A lot of business owners don't think that way. They don't think about team. They don't think about 80-20 rule on customers. Most businesses should focus on one customer segment, one type of customer, and grow to $5 million and then differentiate. Most businesses don't try to do that. They try to just answer every need that comes across their table.
And for our audience, what is the 80-20 rule you mentioned?
80-20 rule is simply saying that if you look at your, once you have enough traction and experience in the market, you look at your revenues and you say, 80% of my margin is coming from 20% of my customers. Let's maximize those 20% of the customers. Let's make sure we do all of our processes and approaches to actually maximize our penetration of that customer segment, because that's where we're getting the most value.
And for that 80% that isn't contributing that much to the margin, is there things you can do to improve the margins from the 80%?
Well, I think that's the question. You have to look at your margins and see if you can either live with greater scale and therefore more overall contribution margin, or you look at saying, hey, what can we do to sell more to this client? I mean, there's three ways you increase your revenues. You increase your prices, you sell more of what, so it's market share, it's sell more, or you sell a lot of different things. It's wallet share. So you have to do one of those three things, either raise price, get better wallet share, or get a better market share.
Okay. And what with the downturn or the volatility in the market, let's just call it that, what can a smart business owner do to help insulate themselves from all this volatility?
That's a great question. Just what you would do whenever you run into challenges in your business. You improve your cadence, because weekly clarity is much more powerful than a monthly confusion. You look at your, once again, the 80-20 rule. You look at 80-20 rule in your employees, and you try to figure out, get with your senior team and determine, hey, let's assume we have a 20% downturn in our top line. Okay, what do we need to do? What will we do if that's occurring? Maybe some of those things we should do now, whether it's change your product structure, your pricing, your terms, whatever it might be.
And I'm sure you've talked to some of your clients after you've done a successful project with them. What do they say most changed for them because they worked with you?
That's a great question. Mostly they say the team stepped up. We got greater clarity and the team stepped up. The CEOs will say, I'm beginning to love my business again. But mostly it's about, hey, we got a plan, we committed to the plan, we were able to execute against that plan. Because even if you're not succeeding in execution against the plan, you at least know where you stand, you at least know what your opportunities are. If it's unclear where you're going, you'll get there, but you won't like it when you do.
So better accountability amongst team members.
Accountability, cooperation, roles and responsibilities are clear, those types of things.
Well, it sounds like you got a lot of value to businesses and help business owners. So I'm really pleased that you're on the show today, Doug.
Well, when business owners do well, they need to sell their businesses, and that's where ACT comes in.
That's where I come in.
So that's where you come in. So the question I have for you is, what are the sort of things that founders don't realize when they're considering selling their business, whether it's in the next 6 months, which is going to be really challenging, or in the next 3 years? What do they need to focus on?
Well, most business owners focus on top line growth. And really, that's not what's going to get you that best valuation. You really need to think about the deal structure and what you're going to personally walk away with. So you have to focus on, you mentioned it, planning. You have to get a financial planner in to guide you on tax efficiency. You have to get people like myself in to really help you dress up the business for sale. As a former venture capitalist, I sat in the investor seats, so I know what the VCs and the private equity firms and the buyers are looking for. So the business owners need to partner with somebody that has that experience, because it's not just about what the revenues are and what the EBITDA is. So most sellers don't really realize that.
So what sort of activities are immediate, like kind of, let's get started on selling this, or getting this business evaluated and possibly prepared for sale? What are the sort of activities you do near term? What sort of activities are done long term?
Sure. Great question. So near term, you got to have GAAP prepared financials, and the financials need an annual audit. Again, think of, as a business owner, if you had a venture capitalist that was invested in your firm, you would have audited financials, you would have at least quarterly board meetings, you would have minutes of the board meetings, you would have an employee handbook, you would have your sales processes documented, you'd have had your operations so that they can scale, because if you were a $7 million business and you want to go to a $17 million business, you can't keep doing business like a $7 million business. You have to scale. So putting the mindset on of, I have professional investors in my company, even if you don't, but you need to operate like you have a professional investor in your company. Now that's short and medium term. Long term, you need to develop your bench strength. So you need to hire below the CEO so that the CEO can legitimately tell a person, like a banker like me, yes, I can take vacation for 2 weeks and the wheels aren't going to fall off the truck.
Actually, when I was CEO, if I took vacation for 2 weeks, the business ran better.
I believe that.
You said two things which are very interesting. One was GAAP. I mean, GAAP scares a lot of people away. What do you say to that?
It shouldn't scare people away, because that's how any investor is going to look at a business and want to see GAAP financials. It doesn't mean you can't keep a separate set of books, but you have to keep the professional set of books for your deal room so that the business gets the highest value. You have to have credibility in the finances.
So adding to what you were sharing about, the interesting notion of what you're saying is that if you want to sell to professional investors, you should run your business like you're already being invested by professional investors.
Yes.
That they're not going to buy something which looks like it's a piece of miscues or confusions.
Yes.
Well, they're not going to pay top dollar. Let's put it that way.
Yes. And I think we need to bring our guest on. But before that, I think you took a question from the audience.
Yeah, it's from Robert Small in Philadelphia, and this is kind of interesting. And given your pedigree in venture capital and mine, we can answer this, I hope. What are some of the risks in venture capital finance? And from an owner operator, it's really there's a couple different things, just practical, on taking on outside money. One of the big things I see is people don't take on enough money because they're afraid of dilution. And you take money when you can find it, and as long as it's good money. And good money means you understand the terms, that you can live with the terms, good and bad. You need to do some scenario planning, and that the investors are going to be people that you can work with. I think Tami, you and I had a conversation some time ago, and you said, getting a VC investor is like getting married, and it is. You're going to be bound legally,
Mm-hmm.
And so the nature of their focus and the nature of their input and their guidance, is it going to be constructive or is it going to be destructive? And Tammy, I think you can probably add better than I can about some of the strategic value that VCs bring on.
Yeah, the VCs are very strategic if you find the right one. They save you time, they save you money, they'll help you scale, they'll help you hit that inflection point much quicker than you could do it on your own. And time is a commodity, right? We can never create more of it. So you're paying not just to take in the money, but you're really paying, if you get the right VC, to leverage all their contacts, all their knowledge. They're going to make sure you hire an investment banker when you go to sell. They're going to make sure you have GAAP financials and audited financials. They're going to really add value. But we need to bring our guest on, Rick Neyman from Patriot Insurance Services. And if you have a question to ask us, here's how you send in your questions to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Rick, welcome to Money Matters. Rick Neyman from Patriot Insurance Companies. Rick, tell us about insurance and captive insurance. What's the differentiation between what your firm does and what Life Insurance of North America did back in the day?
Well, thank you, Tammy. I guess the first thing I'll say is that Patriot Growth Insurance Services, we're a national insurance broker. We actually have solutions for every type of insurance, including life insurance. It's not my specialty, but we do have partners that do that.
Okay.
And we help connect our clients with whatever the need is. But specifically around captive insurance, which is one of the areas that happens to be warehoused in my practice in South Florida. I'm an alternative risk practice leader. Captive insurance is insurance that's provided by a captive insurance company. And a captive insurance company is, in many respects, just like any other insurance company, in that it collects premiums, it pays claims, and hopefully generates a profit for its owners. But the difference specifically with a captive insurance company is that the captive insurance company and the businesses that it's insuring share common ownership. So you've got that common ownership between them. And that's a bit of a generalization, but in the vast majority of cases, that's the main differentiation.
So if I have a big company where I spend a lot of money on premiums, whether it's workers' comp or automobile insurance, I could form a captive insurance company?
Potentially, yes. Potentially, yes. And so it just depends on a variety of underwriting factors. So the first thing is you need critical mass, you need a certain size. Usually we're looking at, the coverages that you mentioned are all suitable, but usually we're looking at about $500,000 of combined spend for general liability, auto liability, and workers' comp to begin, really having a captive conversation. But if you happen to be in one of those categories where you got a very large fleet of vehicles, let's say, 5, 6, 7, 800, 1,000, and your premiums are over $1 million or especially over $2 million, absolutely. You're missing out if you're not exploring this possibility.
So Rick, is it liability based or is it property and casualty based as well?
So, Doug, that's a good question. At a certain size, there really isn't a type of insurance that you can't put into a captive if it's big enough. Practically speaking, for most mid-sized companies, it's going to be more their casualty-driven line. So you're going to have general liability, auto liability, workers' comp, and umbrella coverage, which in recent years we're putting in captives more and more with a spike in umbrella pricing. So that's the majority. But here in South Florida, we've actually seen a spike in property-related captives because property insurance and windstorm coverage has gotten so outrageously expensive that a lot of business owners, out of frustration, are turning to taking on more risk and self-insuring layers of their property portfolio in a captive.
But again, for a property insurance captive, you need to have premium more than 500,000.
Oh, yes. Usually, if you're going to be considering a property captive, your premiums are going to be north of $1 million.
Okay. And are there different types of captives?
Oh yeah, absolutely. In fact, it's funny. I do a lot of education with other professionals, lawyers and CPAs on the subject of captives. And at this point in the discussion, I say the word captive is really a generic sort of term that's very broad. It's more of a category of insurance. And it's not as unlike the word building and construction. There are all sorts of different structures that get the label building, but you might have a hospital, you might have a warehouse, you might have a shopping center, and in captives, depending upon the need and the particular situation, the largest are called single parent captives. This is what Fortune-sized companies do. And then mid-sized, middle market companies will often take advantage of rent-a-cell captives, series captives, cell captives. And then smaller companies, as you kind of move down, form together to form their own group captives. So you might have anywhere from as few as 10 or 12 to as many as 500 or more businesses that all collectively own and manage an insurance company together and leverage their economies of scale to save money.
So that sounds like a lot of extra complexity and cost. What's the trade-off? I mean that's where you guys come in probably, but yeah. What's the trade-off? How much additional overhead are you spending in order to save what sort of get greater efficiency? What type of efficiencies? How do you demonstrate the ROI? I guess is the question.
Doug, I love the way you think, because there's always a catch, isn't there? You know, anytime there's something like this, why haven't I heard about it? And what's the catch? Well, is there more work? Absolutely. There's a lot more work. There's a lot more complexity. What we're doing is we're unbundling insurance, and we're basically constructing an insurance company from the ground up. But what's counterintuitive is that work falls more on the broker and on the captive manager and on the professionals. It's a lot more work for us. It's a lot less work, generally speaking, for the client. In fact, I can tell you, I've had many clients where I started off managing their insurance program in a traditional paradigm where we went out to the open market every year and we shopped their insurance and we got the competitive bids and we negotiated it. And then they moved into a captive. The conversations and the work that took place for the business owner and the traditional was 10 to 20x, if not more, than what they experience in a captive. In fact, I just renewed a client, her third year in a captive. It was a 20-minute phone call on a conversation to renew a $3.5 million auto insurance program that used to take her probably 20 hours of work every year.
Wow. So how are claims handled? If you file a claim with a captive, what's that process?
So that's one of the things is, relating back to what Doug was saying, there are all sorts of different professionals that come together to help manage the insurance program under a captive. So you got the captive manager is one of the main ones. There's the broker. There are all sorts of others, but one of them is the TPA, or the third party administrator. This is a company that specializes in doing one thing, and that's handling, managing, and adjusting claims for insurance companies. And you don't often know this, but when you make a claim with your homeowner's company, the person that comes out might not work for your homeowner's company. They work for an independent third-party administrator or claims administrator. And the same thing happens with a captive. There are a lot of different companies that we can choose from that will actually manage the claims for us. And that's one of the biggest opportunities to control the cost of a captive, is by expert claims handling. The more you can keep the claims expense down, the more you're going to control your cost of insurance and your larger cost of risk over time.
And if there's a really large claim, how does the captive pay, like a multi-million-dollar claim?
Tami, I get that question a lot because I'll talk to a client and, they might pay $500,000 or $1 million in premiums. And they're like, what happens if I end up having 2 or 3, $1 million claims in a particular year? Well, with a captive, just like with other insurance, we're following the same principles. We go out and buy wholesale insurance, also known as reinsurance. So we're able inside the captive to limit our exposure on any single claim We could start off as low as 150, but usually we're taking 250 or $350,000 of the first claim, and then we buy reinsurance up to a particular threshold. And then over
Mhm.
time, as the captive generates profits and builds up more and more money, we're able to raise that and buy less reinsurance over time. And we just adjust the amount of risk we want to take based on the particulars of every business and their risk appetite.
So
Okay.
it raises a question for me. We're talking about paying out claims. What happens if there's a dispute on the claim from the adjuster? The adjuster doesn't agree with the costs in the claim. How do you manage that?
So, Doug, this is a question that you tell me if I'm wrong, but this is an area of major frustration for a lot of business owners because you're tapping into sort of a raw nerve of a lot of large buyers of insurance. Is that there's often disagreements in traditional insurance on how
Mhm.
a claim should be settled, and again, counterintuitive. A lot of times, insurance companies are quick to settle a claim or overpay a claim for workers' comp or auto liability in a lawsuit, as opposed to fighting it. And then that payout ends up going on the claims record of the business owner, and it drives up their premiums in successive years for as many as 5 or more years. And so it's a major bone of contention about how claims are being settled because you've got an insurance company that it's written into the contract they're allowed to settle the claim however they think it's best, however they think best. And if there's a choice between their interest and your interest, they're going to do what's in their best interest. And so business owners are often left very frustrated. Now, in a captive, because you own the insurance company, the buck stops with you. You have the ability to settle claims, to fight claims, and to handle them as you think best for your particular business. And so this is an area some businesses are more involved than others. Some are completely hands off, but I have some clients that get very, very involved in their claim settlement. And they're actually giving us direction on particular claims that involve litigation, such as, don't settle this claim for more than 250. I want you to fight this out of principle. And, it's very gratifying or satisfying, at least for a lot of business owners, to have that power. And it's one of the main motivations for certain businesses to even enter into a captive is to get that power back on how the claims are going to be handled.
Yeah, and I would think that you would want to at least get a partial payment on a disputed claim, which some companies will hold up the entire payment until the claim is resolved.
You're exactly right. And that, again, when you're dealing with an insurance company, you're dealing with their systems, their processes, and their best interests. And an insurance company is in the business of insurance to make money. Let's face it, just like all of us are in business to make money. And so they're making rational decisions based on what's in their best business interest. In a captive, it's a different set of rules. It's your rules. So you have the ability to either make a partial payment, to settle the claim, to fight the claim, to drag it out, to move it along. And for a lot of businesses, insurance is one of their top line items. And a spike in their insurance expenses because of a large claim can literally affect how effectively they can compete in their industry and their marketplace. So this is really a very critical area for a lot of businesses, especially those in contracting and construction classes.
So you're describing friendly insurance without the mascot.
I think I don't want to look. There's some great insurance companies out there, and I have a lot of great relationships with insurance carriers. But at the end of the day, most of the time these claims are settled in such a way where both parties are happy with traditional insurance. But there are cases where there's a conflict of interest, and yes, it's a much more user-friendly type of insurance. Because the business owner at the end of the day has all the power to do what they think is in their best business interest.
Cool.
So other than how much you're paying in premium every year, what's the process to find out if a business is a good fit for a captive?
So usually in our industry, what you'll have is a consultant like myself will try to get you to engage in what's called a feasibility study. And a feasibility study is a very involved process. There are actuaries involved and real fees that are incurred, and they usually cost between $10,000 and $50,000 to do a feasibility. At the end, you'll have a full-blown business plan and pro forma. With Patriot growth and out of our practice, we realized that that's just a barrier to entry for a lot of businesses. So we've developed what we call a viability study, which is a feasibility study light that doesn't, have any expenses. So with a limited amount of data, we can generate with about 80% confidence what the likely impact of a captive will be.
Okay, that sounds great. What other questions, Rick, do we need to ask you so that you can present to our audience what the opportunity really is for them thinking about a captive?
So what I would say, Tami, is that if there's a business out there that number one is frustrated with how their insurance is being handled, they're paying in excess of $500,000 a year, and if they
Mhm.
find that they're putting in $3 into the insurance machine for every dollar they're drawing out in claims, there's that 3-to-1 premium to claims coming out. It
Mhm.
wouldn't do them, it wouldn't be a bad decision to go ahead and to pick up the phone and talk to, a captive consultant and investigate it a little bit further. But certainly anyone that's paying more than $2 million a year, there's a missed
Mhm.
opportunity, especially if you have a large auto-driven fleet. What we're finding is that clients that are paying more than $2 million a year for their auto and umbrella and excess liability, we're saving those clients routinely 30% or more. And I've saved multiple clients over the past couple of years more than $1 million.
What
Wonderful.
particular geographies are more amenable to captive insurances?
It doesn't matter, Doug. It could be any geography. I mean, it's certain states are just harder to do insurance in general, but
Yep.
the differentiation of captive. In fact, I think the harder it is to get insurance, the better a captive will be a fit for that business.
Cool.
So California, Florida, New
I'm working on
York.
a working on a large 6,000 person company in California in a tough industry that
Mhm.
insurance is actually the biggest strategic threat to their business, which is ironic.
New
Mhm.
Jersey?
Mhm.
That was California, but New Jersey is absolutely, yes.
Yeah.
New Jersey's great. South Florida, Massachusetts, Texas. I mean, there's, anyone right now with a very large fleet of vehicles. That's where we're busiest because
Mhm.
those are situations where we're routinely saving people 30% because the insurance market typically is pricing you 3 times your average claims over 5 years.
Wow. Wow. Well, Rick, it's been great having you on our show. Do you have any last minute
Thank you.
questions, Doug, for Rick before we
No,
sign off?
Rick, I just want to thank you for being on our show. So thank you.
Doug, thank you.
It's been
It's an
really
honor.
great.
Thank you,
Um,
Tami.
you're welcome. Our next guest is Leo Chubinchivila. I always just really have a hard time with that name. Access Wealth. Leo is going to tell us about why financial planning is so important. Thank you for being on our show, Doug and Rick. And thank you, our audience, for joining the show. We had a great show. This is Tami Fratis, Managing Director of ACT Capital Advisors, signing off.